Excel accounting practice problem. Invoice form. Get ready, because we're about to excel with Excel. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, 2 tabs down below, Example tab, Practice tab, Example tab in essence being an answer key. Let's take a look at it now. In prior presentations, we put this worksheet together from a blank sheet, so that's a great exercise if you want to look at it. We're going to use this worksheet now to record sales transactions which, if you're using accounting software, will typically be done with invoices and or say a scanner. So if we go on down below, this is a kind of invoice that you would typically see in accounting software. The invoice usually being fairly straightforward to do the data input, and you can do the data input if it has been set up properly without knowing too much on how to set up the process to do the data input or knowing how much it's going to have an impact on the financial statements, which is nice. But what we want to do is kind of drill down and see what the setup process is going to require and what the impact on the financial statements would be. So the fact that it's going to be an invoice means that accounts receivable is going up. We're not getting cash or money or payment at the point in time. The goods and service that we're providing to the customers are happening. We're going to get paid later and therefore must track the accounts receivable. The other side then is going to go to sales, and the sales transaction or the sales item will be not just an account down here. In other words, we're not going to just record a sales account that it will be going to, but it will be driven typically by items, service items or inventory items. That's the more complex part that we have to set up with the accounting system to name the item. And then when we select the item, it should pick up the proper amount here that we're going to be charging. If it was simply a service item, the general transaction would be more straightforward than inventory, simply increasing the accounts receivable. The other side then going to some type of sales account, typically on the financial statement. The item then allowing us to basically group and package the types of things that we sell into the items and give a standard price so that the person that's doing the data input can pick that very easily and then do the data input related to it. It's going to get a little bit more complex when we get to selling inventory, because in inventory, we're going to have the same process where the invoice means accounts receivable is going to go up, but we're also typically going to have to deal with sales tax. In the US, sales tax or usage tax is not usually done for service items. It's usually a state and local type of tax, which could be applicable to inventory items, which complicates the situation a little bit. So in that case, for example, here, if we chose these items and we had sales tax related to it, we'd sum up the amount of the total. The data input could be fairly straightforward. Here they have a tax of the 7.5%, increasing the amount that is owed by the tax. That means that we are owed now $5,418 from the customer. So we would increase accounts receivable by, in this case, that $5,418. But the other side going to sales would not include the sales tax, but it going up or increasing revenue by the amount less the sales tax, because that's the amount that we actually charged. The idea of sales tax being that the tax is not actually on us is the concept of the idea. From an economic standpoint, we could debate that, but the tax is not really on us, the business. It's to the customer. They're just using us as the collection arm for the government. So that means that we're not going to record this amount as revenue, the full amount, and then an expense related to the tax, because it's not really our expense or our charge. It's the government's charge to the customer. Therefore, we're going to have a payable that's going to go to that 3,378 sales tax, increasing the payable, and then we'll pay it off to the government, it never hitting then the income statement. And then the other side's going to go to sales. So we've got accounts receivable going up by the 5,418. We got sales going up by the amount not including the sales tax, and then the tax payable going up for the sales tax. And we're going to have the fact that we need to track the inventory, these being inventory items. If we're tracking that in the system, we're going to have to decrease the amount of the inventory, which is for an amount not on the invoice. In a similar way as if you're in a grocery store and you're scanning your items, you only see the sales price. You don't see the cost to the store. But when you scan it, the scanner knows, or in this case, the system knows, because of the items. As we do the data input in the items, inventory would then decrease. And then we would also have a transaction to the cost of goods sold, related to the expense of us selling that inventory item. Okay, so let's go ahead and do that. We're going to do 2 transactions up top, one as if it's a service item, and then take a look at that more complex inventory item. Let's go to the practice tab to get it done. We're going to start off, we're going to imagine we sold a service item, and note when we make the invoice, even when you do a service item, by the way, down here, you'd still want to have items. You could do it on an hourly rate method, but if you can kind of package your service items together, like if it was bookkeeping and you were able to say, I'm going to charge you by so many transactions. If I do more than 25 transactions, I'm going to have a set price. Then you can create an item for it, which will not be dependent on your billing, but on your time. And that can make it a little bit easier if you could standardize that way. Just a suggestion. But in any case, the service item is fairly straightforward. We're going to say $315. And it would be increasing the accounts receivable because we're going to have to bill for it. If you're a bookkeeper or a lawyer, for example, you're going to have to count your hours or figure out how your billing structure will be and then bill for it, invoice for it. Remember that the invoice represents, in terms of accounting software, it's the same thing as a bill kind of, but the invoice represents the item or the bill that we're sending out, and a bill for the accounting software usually represent something that we're going to be receiving for goods and services that we receive from a vendor. Okay, so that's going to be, and we're going to say that's for 1,600, just making up that amount. The other side is simply going to go to revenue down below. We're recording revenue even though we have not yet got the cash because we're on an accrual basis. Accounts receivable is an accrual account. If you are on a cash basis, you wouldn't even record the transaction until you receive the money. If you're in a type of industry where you need these transactions, then you're going to have the accounts receivable and use some kind of accrual method. So let's go ahead and record this. This one's going to go to accounts receivable. So accounts receivable is not cash yet, but still an asset, increase in the asset. This is going to be equal to that 1,600. It's going from 2,000 up by 1,600 to that 3,600. Then we're looking sales. Sales is going to be down here on the sales item. We're in H15 equals, and then I'm going to scroll back up and we're going to be pointing to that credit 1,600. So sales is a credit balance account. It goes up in the credit direction to that 201,600. Let's record this then on the general ledger. Here's our accounts receivable. That's going to be the third account, accounts receivable. And I have this beginning balance red because if you used a prior worksheet, I had set this up prior to be taking that beginning balance from the end here, which is going to throw us off. So make sure that that first formula, which it should be in your example tab, is being picked up from the beginning balance here and as you go forward. So it shouldn't be a problem. I'm going to unredify that, making it green. Okay, so this is going to then be on, we said 315. This will then be equal to, scrolling to the left, scrolling up, we're picking up that 1,600. The debit balance of 2,000 going up by 1,600 to 3,600. That 3,600 matching what is on the receivables on the trial balance. We're out of balance now by that 1,600 up top on the GL. The sales are going to be on the 1,600. That's the first income account. The GL accounts are in order, so we're going to go to the right. We've got the assets, we've got the liabilities, we got the equity, then we got income and expenses. We're looking for sales. That's in AI, so we're going to say on 315, I'm in cell AJ5. So we're going to say equals. I'm going to hold the left arrow down until I hit the wall. Hitting the wall, we're going to be picking up that 1,600 in cell D3, enter, double clicking on it. There it is, D3. We went from 200,000 credit balance up by 1,600 to 201,600. Scrolling back to the right, that 201,600 should then be on the trial balance as it is here. And then we could see that we are in balance up top on the GL as well. Also, we hit the accounts receivable account here. So that means that this account shows that people owe us money. I want to know who owes us money. I can't get that information simply from the GL, therefore need a subsidiary ledger breaking our data out by customer. So I'm going to go all the way to the right to get to the accounts receivable subsidiary ledger, which you got to do every time you hit the AR. And I'm going to assume it's going to be customer 4 down here that we sold money to. That's a generic name, customer 4. It's 315. I'm going to say on BD17 is going to be equal to, I'm going to hold the left arrow down till I hit the wall, all the way to the left till I hit the wall, scrolling up to the last transaction, looking for the accounts receivable to 1,600 and enter. You can also just hit equals C2 and it goes from 0 up by 1,600 to 1,600. Now, if we take our 4 customers here, add them up, they add up to 3,600, which does match what's on the trial balance indicated by this 0. Let's double check it though. 3,600 going back over to the GL and or trial balance is what's on the trial balance as well as the GL. Okay, now let's do the more complex one. We'll say, what if we're selling inventory and we have sales tax that we're going to be dealing with? Let's do this. We're going to say 450. And this is the transaction that will kind of be built behind when you create an invoice or when you say scan something at the grocery store or something like that, with what they're going to be recording in essence with that transaction. So we're going to say, all right, the accounts receivable is going to go up still, and I'm going to have sales go up, but I'm not going to record the sales yet because I need to figure out the sales tax. So what I'm going to do is say, okay, then I'm also going to have sales tax. I know that's going to be impacted as a liability. And then I'm going to have the revenue account down here. I'm going to have the revenue account. I'm going to try to start off with the revenue because that's what we actually charge for the item. Now, how will I know what I charge? Let's say we're going to be selling 40 units of inventory. So let's say they brought up the inventory, they got 40 units of something. If it was an invoice, I would simply select the item here and say 40 units of that item, and it would give me the unit price, and that's how it would be figured out. How would we do that in our system? We'd have to say, okay, well, where is it going to pull that from? It's going to pull that from our inventory register. So if I go all the way to the right and I say, okay, let's take a look at my inventory register. This is the cost of the inventory. So let's say we're selling this item 1 again. Now we're selling it on 415. And I'm going to go to the cost of goods sold area because it's going to be decreasing the inventory, recording the expense related to that cost of goods sold. We're going to say we're going to sell, I think I said, what did I say, 40. We're going to sell 40 units at $50. Multiplying that out, that means it's going to be 40 times 50. That's not the sales price, that's the cost. That's the cost. So that means that the ending inventory after we're done with this means we're going to sell 40 units at $50. And that's going to mean I'm going to multiply this out 40 times 50. Let's underline this font group and underline. And then I'm going to say that means that we have 50 minus 40 or 10 units left. And this I'm going to say is equal to 2,500 minus 2,500 $500 worth of units. And then I'm going to back into the unit price, which will still be 50 because we didn't change any of the prices. It's going to be 500,000 divided by 10 or 50. So once we're done, we'll have 10 units left at $50, ending balance at $500 worth. And I'm also going to say that there's an 80% markup. So that's going to be the cost. And then there's an 80% markup. So the 2,000 is the cost. Let's go all the way back to the right. And I'm going to say this, then the sales price. I'm going to do it this way with a formula just so you can kind of see it when you go back to it. Even though this is a tedious formula, I'm going to say equals. I'm going to go all the way to the right. I'm going to be picking up that 2,000 that we calculated. And then I'm going to divide it by 80, 0.8. So 2,000 divided by 0.8. The reason I'm doing that is because we're going to say 2,500 times 0.8 would be 2,000. So it's 80%. So 2,000 and 80%. The cost is 80% of the sales price. So we're going to say there it is, 2,500. And then we're going to have sales tax. I need to make that also a negative because sales is going to go up with a credit. So I'm going to say negative in front of that. So it's negative 2,500. Sales tax, we're just going to imagine is 5%. That's going to depend on your state and local. If you're in the United States, so it might be a usage tax. that will be dependent on wherever, whatever government's charging you the tax on it. So I'm going to say this is going to be equal to the 2,500 times 0.05 or 5%, and assume that we have to pay another 125, or the customer has to pay that. Remember, that's the customer's tax in essence. That means we're charging for the customer on the accounts receivable. This is what I call the plug formula, meaning I want to sum this up and then reverse the sign. So I could do this with a negative and then SUM of these items. And there's the plug. So we need to be collecting from the customer 2,625. So that's kind of what we did down here on the invoice. If we look at the invoice down here, you say, okay, this is what we charged over here. And then they had to calculate the sales tax on it. Therefore, the customer is going to give us the amount plus the sales tax, but we're only charging the amount that we actually charged going to sales. The difference is going to go to the sales tax payable. Then we'll deal with inventory. So same kind of concept here. This, of course, now ties out to 0. We're also going to have the inventory, which I'm going to do with a separate transaction, not because it happens at a separate time, but because it's often easier to think about these two things separately, because this is balanced up here. And then you can think about what happens to inventory. Inventory is going to go down. Inventory is going to go down. So I'm going to put that on the bottom. And then cost of goods sold is the other side. That's the expense of us basically using up or consuming the inventory, moving it from the asset down to the expense. It's going to be for the amount of, I'm going to pick up that 2,000 all the way to the right again. I'm going to try to tie it together. So you see where the 2,000 comes from. It comes from that ledger, from the subsidiary ledger. There's the 2,000. And then I'm going to say negative of that 2,000. I'm going to do some indentations on the credits. So there we have it. So you can have two kind of things that you're thinking about here. Accounts receivable is going to go up by the amount that we're selling the units for, plus the sales tax. Then we're going to have sales, which is going to be just for the amount that we charge for the units, which we're not getting from the inventory subledger, but we might have a standard markup that we're going to be using, sales price different than the cost. And then we're going to have the sales tax that's going to be applicable, and inventory is going to have to go down. This is coming directly from the subledger, which is tracking the cost and the related cost of goods sold, the expense of us now spending or using up our asset of inventory in order to generate the revenue. Okay, let's record it out. So we're going to say inventory is up top. Accounts receivable. Something's in accounts receivable, so I'm going to double click on it, go to the end of it, say plus, point to that 2,625 and enter. It goes up again to that 6,225. The sales tax payable is going to be down here in sales tax payable. Is going to be equal to the 125. Notice that sales tax payable does not hit the income statement at all. We're not going to have any sales tax expense either, because it's going directly to the balance sheet, because it's not us charging it is the idea. And then we're going to go to sales, double clicking on sales, going to the end of it, plus picking up that 2,000. It goes up or increases the sales, increasing the net income, putting us back in balance. I'm going to record this now to the general ledger. To do so, I'm going to try to highlight these as we go so I don't get confused. So this is something you might practice doing if you get kind of confused on which account you're working on. You might say, I'm just going to make that green for now. I'm looking for accounts receivable. That's the second account in the GL. Scrolling to the GL, so there it is. That's not the second account, it's the third account in the GL. So here it is in AO18. We're going to say 415, put our cursor in AP18. This is going to be equal to, going to the left, scrolling up. There's that 2,625, increasing the receivable from 3,600 by 2,625 to 6,225. That 6,225 matching then what's on the accounts receivable here on the trial balance. Our GL out of balance now. So now I'm going to ungreen this, and I'm going to greenify the next one, going to make that blue, and I'll greenify the next one. We're on this one now, making that green, and I'm going to say that's the sales tax payable, which is the last orange account. So it's in order up top. We got assets in green, liabilities in orange. There we have our sales tax payable. So we're down here. I'm going to say 415. We're in cell AB17 equals, holding the left arrow till you hit the wall. Scrolling up, we're picking up that 125. So there we have it going from 0 up by 125 to 125. That 125 should also be on the trial balance. It is here. We're still out of balance till we record that last part. So I'm going to ungreen this one. I'm going to ungreen this one. And I'm going to make this last one green. Right click and make it green. And say that's the one we're on. Sales, that's the first account that's on the income statement. It's in order, so we're going to say assets in green, liabilities in orange, equity in dark blue, and then sales is the first income statement account in AI6 415. We got our cursor in AJ6. Now this is going to be equal to, holding the left arrow till we hit the wall, and we're picking up that 2,500. Enter. So that increases because it's a credit to a credit. 201,600 increased by 2,500 to 204,100. That 204,100 should then be on the trial balance, which it is right there. And we're back in balance up top, even though we haven't recorded the inventory side. That's why we can kind of think of these as two transactions, although they happen at the same time with typically the same form, the invoice. Now we'll look at the cost of goods sold. So the cost of goods sold represents the expense related to the inventory we consumed. I'm going to record that first to the trial balance right down here. This is going to be equal to the 2,000 and enter. So that means that it's going to go up. So 160,000 plus the 2,000 to 162,000. And then the inventory up top is going to go down. So we're going to be in H7. This equals the inventory of the 2,000, taking the 4,375 down by 2,000 to 2,375. Note the net effect on the income statement is the increase in the revenue minus the cost of goods sold. We only see on an invoice that the impact on, in essence, revenue. We're not going to see, and plus we're going to have sales tax that even muddies that up a bit. But really, if you look at the transaction and net impact, it's going to be the revenue is going to go up, but then whatever the cost is also going to go up in terms of the expense, which will bring down the net income. The net impact then being the difference between the two, in this case, a net increase of 2,100. Okay, so now let's record this to the general ledger. Cost of goods sold is going to be like the second income statement account. It's in the same order. Assets in green, liabilities in orange. We're looking then equity, dark blue. We're looking for cost of goods sold, which is down here in AI17 on 115. Putting our cursor in AJ17, hitting equals, holding the left arrow down till we hit the wall. There's the wall. And then we're going to go, don't hit it too hard, but we're going to say 2,000. There we go. We got the 160,000 plus the 2,000 increasing to 162. That 162 should be on then the trial balance. There it is, the 162. We're out of balance up top by the 2,000 until we record the other side, that being inventory. Inventory is an asset, so it's right here. We're going to say that happened on 115 as well. Putting our cursor in T5. This is going to be equal to then the inventory going down by that 2,000. So now we've got the 4,375 going down, doing the opposite thing to it. A credit, it's a debit balance account to 2,375. That 2,375 also matching what's on the trial balance, 2,375. GL back in balance as well. That looks good. Now also, we impacted the accounts receivable account here. So we also need to see that by customer, who's going to owe us the money, so we can track who's going to owe us the money. So we got to go all the way over to the subsidiary ledger because we need something plus or added on to the general ledger, tracking it by customer and not simply by date. I'm going to assume that customer 1 is who we sold this one to that already owes us $1,000. Now on 415, I'm putting my cursor on AZ5. I'm going to say equals, holding the left arrow down till we hit the wall, hitting the wall, and there's the 2,625 that they're going to owe us. That includes the sales tax. and that's the 1,000 plus the 2,625 brings us up to the 3,625. If I add up all 4 of the customers we have, then that adds up to 6,225, and that ties out to the trial balance indicated by that green 0, but let's double check it. 26225, going all the way back over, we've got the 6225, there it is, and the inventory should now tie out as well because we already adjusted at the start the inventory subledger, so that 2,375 then should tie out. If I go all the way over to the inventory subledger, we've got the ending balance of the inventory, which is this item, which if we add up the 2 inventory items, we're left then with 2,375 left after having sold 40 units at a cost of 50, which was that $2,000 that we sold. That's the cost, not the sales price. So that ties out too. And then if we look at our financial statements, we could see that we're still in balance over here. We can see that the accounts receivable has gone up. We can see that the inventory account has been impacted. And then on the revenue side, we have a change in the revenue and the cost of goods sold. If you were to enter this transaction or enter an invoice into an accounting system or scan something or something like that and then had access to the financials, you would probably then go to the financials and then start drilling down on the accounts that would be impacted, such as accounts receivable and sales, for example. If you drill down on accounts receivable, double clicking on it in a lot of softwares, it would then take you to, in essence, the general ledger, which might be called some kind of transaction detail report, but it's basically a ledger that's breaking the information out by date, which would look like this, which is in essence a general ledger, giving you the detail there. If you further drill down on it, it would take you to the source document, which generally wouldn't be the journal entry, but would be the invoice that was used to basically create that transaction. You typically wouldn't be going to the trial balance in software unless you like using the software, which I typically do, and a lot of times because it could be a little bit cleaner without the subtotals. And then if you needed any other supporting information beyond what's in the general ledger, you go to the supporting documentations, which I would call subledgers, because they're subsidiary in that they have to add up or should add up to the same amount on the general ledger, but which might be called something else in the software, such as accounts receivable aging reports, accounts receivable balance detail reports. They're all basically just sorting the same data, but configuring it in other ways, in this case by customer, simply needing to go to the same balance. And then you might also look at an inventory subledger, which it might call an inventory summary, inventory detail report, or something like that. But in essence, it's subsidiary to the inventory amount on the balance sheet and the general ledger, because it should add up in total dollar amount to the amount on those other ledgers.